Hello, everyone. Welcome to the market update for Tuesday, January the 26th. Basically, we kind of a flat market today. Not much is happening. Not too concerned of a pullback just yet, but as we've been pointing out in the last couple weeks, there have been some signs flashing that we're getting close, and there's still some of those same signs that are telling us that we're getting close. So I think if we get another big run where the market kind of takes off for a few days, I'd like to see it go for a few days in a row where it starts to kind of run and really look like things are going again. And then usually about that point, you'll start to see some pretty big bearish reversal signs that start to come in, and hopefully we get those type of signals so we can be prepared to kind of be out or on the sidelines for a pullback, or as we'll kind of learn today, how you can kind of trade make money as the market pulls back as well. The trading I'm going to do today after I do the market update is going to be on shorting stocks. It's going to be just kind of a basic explanation of what shorting is, but the reason why it's important to understand shorting, even if you're not going to do it, it helps to understand the concept to be able to understand the markets in general and how the markets move and what's moving the markets a lot of times. So even if you're not going to do it, it's good to have an understanding of it. And so I'll kind of go over the basics of it. And the reason why I'm picking that topic to talk about today is because there's a lot of news particularly yesterday, there was a lot of news about GameStop and what's going on with that stock. And it involves a massive short squeeze. I'll talk about what a short squeeze is as well. And we'll get into that after I get done with the main update. All right, so taking a look at the direction alerts. Not really anything significant. We're not in the extreme ranges on any of the indicators. Momentum is right in the middle of the buy range there. The breadth is almost in the middle of the high range there, but we're not in an extreme area. And then sentiment, same thing. We're just all in the kind of the high range, but not extreme range. So there's nothing that's really screaming that the market is likely to sell off from that standpoint. Now we move on to the buy-sell ratios. Now we've been extreme on these, but we've been extreme on these for quite a while, as I've talked about, and we did get a little bit of a sell-off that caused the two indicators the buy and sells to come a little bit closer together. Then they expanded again, and just recently they've started to come a little bit closer together. Not much, but they're kind of moving a little bit closer there. So you could still say that we're in an extreme area there, and we are. There's a lot more buys than sells, but a lot of times, and this plays into the breadth of the market, a lot of times you'll start to see these kind of creeping closer together before a sell-off starts to take place, as some stocks some stocks start rolling over sooner than others. And sometimes you can kind of see that here, but so far again, nothing that's really screaming that we're going to get a big sell-off. The sentiment, we started to creep back up to that extreme level last week, but since then we've kind of backed off of that. We are elevated though, so we do want to keep an eye on that. It wouldn't take very much of a move higher from this point to push that sentiment back into that extreme range. And so we'll kind of keep an eye on that. Now, as far as the individual charts, let's pull them up here. Let's pull up the SPY. We just been sluggish for so long now. We had this period where we just kind of bounced back and forth. We looked like we were starting to break out and move right here for 3 days, and then we went into another week of basically moving sideways. Right here, we had another 3-day move. It looked like we were breaking out. So that was last week. And then since then, we've just been kind of moving sideways again. So again, it's still showing that the market is acting like it wants to go higher. That is kind of that stair step behavior, but you're just getting a lot of, you'd like to see to get, a week or two where you're kind of moving in that direction, a little bit of a stronger move. And what this is showing me with these shorter spurts here, you get a quick 3-day spurt and then a whole week of consolidating, is that there's just not a lot of aggressive buying that's going on across the board, at least market wide. And again, we're in a market that's a little bit, it's right on that borderline of being overbought, due for a pullback. There's a lot of traders out there that recognize that, and that's maybe causing them to be a little bit hesitant. But that could change again if the market has a strong couple of days. It could attract more of those aggressive buyers back into the market. I think that's kind of what I'm waiting for, is that final push before I think that the market will be ready for a much bigger correction. You look back, if I've referenced these other corrections that happened earlier a few months ago, you see, this is kind of what I'm talking about. You had this consolidation back here in August, and then you had this run up of a couple weeks right here. And then that triggered a big sell-off day right there, and that triggered the much bigger correction. You had this little run up, you had a consolidation right here, you had this little run up right here, and then that triggered that sell-off right there. Usually when you see these reversals, they're sharper reversals. You're going up, and then you come right back down. You don't see a lot of situations. It can happen, but you don't see a lot of situations where you're moving more choppy and more sideways, and then you drop. That can happen, but it's usually pretty rare. And so, the more the market it kind of moves sideways right here, we can still, I think we can have a reasonable amount of confidence that it's still going to move higher. It's not acting like it's getting ready to pull back just yet. Now, obviously, sometimes what could cause the lower probability outcome, meaning what could cause it to look like it still wants to go higher and then have it sell off in a bigger way. Well, there could be unexpected news that comes out that freaks the market out. And obviously, you can't anticipate that. You don't know what the unknown news is going to be. So you focus on what the probabilities are, what the probabilities are saying, and the probabilities are saying, I think we're still good right here. On the Dow chart, this is another reason why I think the market has another move higher. If you look at the SPY, we did kind of break out of that sideways range more recently here. Same with the Nasdaq 100 and the Russell 2000. Let me skip over the Dow and then we'll come back to it. So on the Nasdaq 100 here, we've recently been in that run up. It's starting to get a little bit extreme though. If you look at the indicator up here, we're in the extreme range there. So I mean, that's flashing that it's overbought and could be due for a little bit of a pullback. But remember, we can stay in that extreme range for a little bit of time. And what I think is going to happen is you might see the NASDAQ lag a little bit, and maybe we see the Dow and the S&P run a little bit more percentage-wise. But I think this could stay a little bit extreme in that extreme range for a little bit of time while the other indexes kind of catch up. Here's the Russell 2000 right here, IWM. It also has recently kind of broken out. Well, more recently, it's starting to move a little bit more sideways again, but it had a pretty good run. It was kind of leading the way earlier in the month. And so my thought process going back to the Dow is that this will end up breaking out, that we'll see those Dow stocks start to outperform. And it could be that all of them just start performing and start running again together. But I don't think we're going to get a significant pullback until the Dow breaks out of that sideways range it's been in. So we'll keep an eye on that. Now, as far as the other charts are concerned, if we move on to bonds, I talked about bonds possibly being at kind of a bottom. I thought that bonds could start to run a little bit. But there's also a possibility here that this is a bearish ABC pattern right here. This is just a correction within the downtrend. You do have the impulsive move down. This could be wave A, wave B, wave C of a bearish correction that could lead to another move lower there. We're really not going to know if we're breaking the downtrend. We've been in this downtrend for quite a while now, until we start acting like an uptrend, meaning we need to probably get above this high right here. There is a little bit of support that we broke through right here that could be resistance on the way back up. So one of the first signs, if bonds are starting a new uptrend right here, would be if it can break above that support. What used to be support now is resistance. Break above that resistance here. Then the next step would be to go to a higher high. That's the previous high right here. Can it go break above that high? It does not have to be all in one move, but it could be kind of stair stepping its way up in that process. But that's when we would really start to notice a trend change and it's acting more like an uptrend if that were to happen. So we'll keep an eye out for that. But the trend still is down, and so we're going to assume that bonds are going to continue that move down until it shows us otherwise. Gold, we were possibly starting to get bullish on gold right in here. I was talking about wanting to wait for it to break to a higher high right there, which it didn't do. It ended up selling off again. As far as just pure chart behavior, you have an impulsive move down. Remember when we did the stair step? I taught you about the stair step analysis, impulsive versus corrective moves. Usually when you're stair stepping up, you'll get an impulsive move up. Corrective move will be more choppy, more sideways. That'll usually be followed by another impulsive move up. And that's what creates a stair step up. Well, in a stair step down, it's just the opposite. Usually you're going to have an impulsive move down. You see more choppy, more sideways. That's corrective. That usually is going to lead to another move down. You're stair stepping down. And that's kind of what I see right here is you got the impulsive move down. The stock is moving more sideways. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moves sideways. That's typically the direction it's going to move in after it's done moving sideways. So the assumption here is that we're not done dropping on gold, that this should at least have another move down, another impulsive move down. We'll see if that ends up taking place. Like I said, the last couple of weeks, it's basically just been in the sideways range here. But I would assume that the next move for gold should be down. Now it can drift up as it's moving sideways. It could drift up a little bit, so it could still go up a little bit in the near term. But I think the next bigger move is still going to be to the downside. We're going to get another impulsive move down. So kind of similar back here, where you have this sharp move down right here. It consolidated a little bit. It kind of moved up a little bit, but it was kind of more sideways. And then the next move was that impulsive move down. Then what you got? You got an impulsive move up, a little bit more choppy right in through here. Impulsive move up, a little bit more choppy. So that's just kind of how markets and stocks move. They kind of move in that stair step. And so with that, I'm assuming that gold is still trending down, and until we see it break that pattern, I'm going to keep assuming that gold is going to continue to be weak. On the other hand, oil is the opposite. It looks like it's been consolidating, but it looks like it still wants to go higher. You can see that stair step here, had an impulsive move up, move sideways, consolidated right here. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving before it moves sideways. That's where it's more likely to go after it's done moving sideways. So we had another impulsive move right there, and then it's been kind of choppy sideways right here. So I'm assuming that once this little corrective move is done, that oil should continue to trend higher. and until we see something different, that's the trend, and we're going to assume it's going to keep moving in that trend until it changes. The dollar looks like it might possibly be in a trend reversal. I talked about the possibility of the dollar reversing trend. Hold on just a second. Get a little bit congested here, so I had to drink a little bit of water there. But the dollar, if it looks like it might be reversing trend. You can see the stair step down right through here, and we had kind of a sharper move down, and we had this sharper move up right here. And we talked about this. I can't remember if it was a couple weeks ago or a week before last, but that's when this move happened. And we barely moved above that previous high. So we did go to a higher high right here, which I said could be, we might be breaking that downtrend. And since then, we've kind of been moving sideways right through here. So it's possible that we're getting one of those inverse head and shoulders patterns that I've talked about in the training before. The key is going to be this area right through here, this neckline, if that is an inverse head and shoulders pattern. If the dollar can break back above there, then we'll assume that trend is now reversing into an uptrend. So we'll see how that kind of plays out. But this is going to be the critical area that we need to get above to really have confidence that downtrend is done. Because if it suddenly drops and you're back down going to a lower low right there, then you're still in your downtrend. You're still acting like a downtrend, and we'll see how that kind of plays out. But we've been consolidating for a couple weeks now, and we're probably getting close to seeing a move. That you can see this doesn't move sideways very often. You had a period right here where a couple weeks it moved sideways and then took off again. So this is probably getting pretty close to moving again. So I wouldn't be surprised, maybe not by Thursday's update, but by next Tuesday's, we might have a little bit stronger direction from the dollar. We kind of see where it's trending a little bit better. Probably in about a week or so, we should have that. Oh, it could be in a day or two. I mean, if it really starts taking off, it could really show a trend there. But I'd imagine that we're going to get a clearer direction on the dollar within the next couple weeks. All right, and then lastly, take a look at the VIX. Another reason why I'm not too concerned about the sluggishness of the market recently is that the VIX has been pretty low. We're still kind of holding this support area. I told you to keep an eye on that. If we break below that, that's going to be very bullish for the market. Especially as long as it's kind of held that support area there. There's also kind of a trend line, if I can draw a straight line along these tops right here. It's not the straightest line, but we tried to, when the market kind of freaked out a little bit yesterday, it then came off the lows of the day, but the VIX spiked a little bit on that. So what that tells me is that the market is concerned right now, and that's why whenever you see some negative news or something that comes out and you see that VIX start to spike, it's showing you, remember what the VIX is showing. It's showing you basically the level of freaking out of the big institutional investors. That's kind of my simplified definition of the VIX. How are those professional traders, the ones that move the market, how are they feeling? Are they concerned? Are they not concerned? Well, the market kind of sold off a little bit, and that VIX spiked up. That's telling me that they are a little bit concerned. Why do I need to pay attention to a move like that yesterday on the VIX? Well, because it tells me that if there's negative news, it's going to come out in the next few days or so, that it has the ability to really cause the market to sell off. And because those professional traders are showing us that they are a little bit concerned, that they were concerned enough to start buying some of those protected puts to hedge themselves a little bit and buy that insurance policy in case the market were to drop. And so now the opposite is true too. On a day like today, we're the VIX is moving back down. Here's where it closed yesterday, and it's moved back down pretty dramatically in comparison to the market move. We're not up a lot in the market. We're basically flat, but the VIX has come down quite a bit off of its close yesterday. So it's telling me that they're right back to not being as concerned about what's going on. Now, again, that can change very quickly, and that's why the VIX is kind of a tough indicator to read, because you're constantly looking for the one indicator that's going to tell you what's going to happen in the future, right? None of them do. None of them can. And so I think that's the first thing when you're looking at any indicator. The first thing you have to accept is nothing is going to tell me exactly what's going to happen next. But that's not what we're looking for. We're looking at probabilities. We're looking at clues, and the clues that we see on the VIX a lot of times are very subtle. Now, remember when I talked about the VIX in the training a few weeks back, I said the VIX doesn't tell you something every day. It doesn't tell you something significant every day. So that's another thing too, is we don't want to assume that we're getting big drastic clues from the VIX every single day, because usually it's not. But when something happens in the market, whether you get a big up day or big down day, and you see an unusual move in the VIX, that can clue you in a little bit to how those professional traders are viewing the move that took place. If you see a big move up, but the VIX is moving up, that tells you that those professional traders don't trust that rally that much. Because they're hedging as they're buying. They're buying stocks, but they're also buying protected puts because they don't trust that rally is going to continue maybe for very much longer, or that they're just concerned. There could be a lot of risks out there that we saw this a lot. We see this a lot when there's like government shutdowns and battles in Washington over things that you don't know what the outcome is yet, and if the outcome is really bad, it could cause the market to crash. But yet it's not. The outcome isn't there yet, so the market could still rally. And if the outcome ends up being positive, the market could really rally. So you want to buy, but you're worried about that unknown risk. So you buy some puts along with it to hedge. So that could be a situation where the market moves up and the VIX moves up. But again, it's information. It's telling us what those professional traders are kind of thinking. But right now, I think that's a bullish sign that the VIX is kind of back down a little bit from yesterday's little spike it made. We'll keep an eye on that support area down here and that trend line. If we break above that trend line in any significant way and hold that breakout, that could mean that'll probably mean the market is already starting to correct, and that we could have a much bigger correction take place. All right. And you can see those last corrections I showed you on the chart, on the SPY chart, this is the VIX spiking on those. Now they ended up coming back down as the market rallied back up, but that shows you there was a level of concern, definitely a level of concern by those professional traders that caused that VIX to spike up. All right, real quickly, let's go over a couple of stocks, and then we'll get into the training. Under the retail sector here, under the holds, I like this one at the top of the list. It's a 98 strength rank FBRR. Now it's down today, but let's switch this over to signals here. But it looks like this could be a possible bullish ABC pattern. Remember, when stocks pull back, a lot of times they don't pull back in one move. They don't usually sell off and then go right back up again. They usually have an initial move down, and then they'll consolidate a little bit, and then they'll have another move down, and then they'll resume the trend. And that's what kind of creates that ABC pattern. That's why I call it an ABC pattern. And it could be that this is the final move down. Now, it could be that this is a trend reversal. I mean, this thing could end up all the way down here. But remember, we're waiting for confirmation anyway for this to go back to a buy signal. It's at a hold signal right now. So as long as this doesn't break this low down here, so it could still drop a little bit further and still be okay. But as long as it doesn't go to that lower low right there, and if it can start to move back up to that buy signal, I think that it would show that trend is still intact, still okay. And so but I think this is very important that you'd wait for that confirmation, wait for that buy signal. Still a little ways away to getting to that buy signal. It'll probably take a few days of moving up to get there. That's one you can kind of keep in a watch list, keep an eye on. Now, another one in the same sector, I think we've gone over this one before, I'm pretty sure, but this FTCH, because we've been waiting. This one, again, I like here's the run up, and then it started to pull back, but it's kind of more choppy, more sideways on this pullback. And I think we noticed it in this area right here. It did dip down to a sell signal, but it's gone back, went back up to a buy right here, then back to hold. But you're starting to see kind of that possible inverse head and shoulders developing. As long as this doesn't go below this low right here, as long as this has a higher low, and again, it's at a hold signal right now. So if it goes back to buy, you're getting this kind of bowl-shaped move or inverse head and shoulders, however you want to call it, but it's a good bullish formation there. You could even, if you didn't quite trust the buy signal just yet, this one did go to a buy signal and then right back to hold again. You could just wait for a breakout, which it almost did on that buy day. It almost broke out on the intraday high there, but you could wait for it to break out. Now, the rule of thumb, if it were to go up and break out, is you can take the distance from the breakout to the bottom of the correction right here, and then project that distance forward. It can give you kind of a minimum target to kind of keep an eye on as where that stock could go if it breaks out. It could go further than that, but that gives you kind of a minimum guideline there. But I like that way this is kind of shaping up. All right, under computer and technology, I've talked about this one before, BLNK, Blink Charging Company. It's 99 strength rank, and it just went to a buy today on a breakout. A really big move today. Now, sometimes you don't want to chase a big move like that. Here was a similar move right here, big move, and then it pulled back immediately from there. But it's still, even with some of these big moves, here's a big move, it went a little bit higher, then pulled back. But it's still stair-stepping upward. It's still getting that stair-step behavior there. It could just go and run. Some of these stocks lately have, and we'll talk about short squeezes here in just a second, but they get squeezed a little bit. And there are a few people that have been shorting Blink Charging Company just because of the valuation is getting a little bit high. But that could cause it to move higher in the near term if there's a little bit of a short squeeze going on there. So, but I like the chart of that and the pattern of that and the story of the whole industry. I think is going to be growing at a pretty rapid rate. All right, another one under computer technology is this Franklin Wireless Company, FKWL, 98 strength rank. And this looks to me, again, you have a nice uptrend through here. This looks like this could be an ABC correction right here. Now, by the way, with ABC corrections, you never know exactly that they're an ABC correction until you're looking back in the past, until the stock breaks out again, and you can say, yep, that's exactly what that was. That was an ABC correction. So that's why a lot of times you hear me say it's a potential ABC correction. I mean, if this thing rolls over and ends up all the way down here, it's not an ABC correction. It's a downtrend. But there's potential for it to be an ABC correction. Obviously, you're waiting for it to go back to a buy signal. But if it can start to move back up and go to a buy signal, that's a nice correction right there that it could really launch out of. Whenever you have these really, you have a nice big move and you get a short correction where it moves a little bit sideways, but it's only been doing it for a couple of weeks or so. It does signal that the stock could move higher, but a lot of times what will happen is you'll get that move higher, but it may not be a huge move higher. And then you got to be worried about a trend reversal again. Is this thing? So as you get closer to the top of these uptrends, the corrections tend to be a little bit more shallow. And like I said, it doesn't mean you can't trade them, but you're usually, my expectation in these types of trades where the corrections are shorter is I have a shorter expectation on the move I'm trying to get. I'm only trying to get a, maybe a $4 or $5 move or something out of it. If you get a little bit of a burst right there, then I'm going to be looking at exiting or looking for signs that that move is over. My thought process is going to be a little more short term. But when you get these larger corrections, these often lead to these larger moves, and these are ones that you're going to usually, if you're going to try to buy and hold these for a long time, or you really want to try to capture a really big trend move, you want to look for some of these bigger corrections to trade off of. So if this thing goes back to a buy signal, it's possible this thing could go on a much bigger run. And again, the reasoning behind that, it goes back to what I was just talking about the target areas. If I have a real shallow correction, well, what's my target area if it breaks out? Well, you can take the distance from the top of the correction to the bottom of the correction and project that distance upward. It should go about that minimum distance. Typically, again, this is a rule of thumb. It's not, doesn't have to, doesn't mean it will, but that's most of the time it will, and so that's why we use it. Well, you have this deeper correction, you can do the same thing. If this thing breaks out, I can take the distance from the top of the correction to the bottom of the correction, but notice how now it has potential for a much bigger minimum move. So if you're looking for these that you can kind of hold for a while and you can get a much bigger move, you want to try to find some of these that are in these deeper corrections. Now, the nice thing about this one is not only is it going through a deeper correction, but it still has that high strength rank. It's a stock that's been outperforming the market over a longer period of time. It's doing pretty well. So you're dealing with a stronger quality stock out of a deep correction. So there's really good potential for it to make a nice run. And one that's had even a bigger correction I like into the computer and technology sector is Zoom Video right here, ZM, which is a 96 strength rank, but still pretty high strength rank. And obviously, the story, and most of you have been using Zoom in one way or another during the pandemic here. But look at that big correction it's kind of gone through. We might be able to see a little bit better going to a one-year chart, because most of its move has happened over the last year. So you have this big run up, and this could be wave A, wave B, wave C, much bigger correction right here. And then on top of that, it looks like you're getting a little bit of a inverse head and shoulders possibly. This is starting to move a little bit sideways. Now let's zoom back in so we can see this a little bit more detail. I just wanted to show you that bigger picture there. You have a possible shoulder, possible head, and then it's kind of had a nice move up right here, and that's moving sideways again. So that could be the right shoulder. It could be starting to work its way back up. Now, a minimum target would be the previous high right here, but if it breaks out above that, you can take the distance from the top of the correction to the bottom of the correction, project that distance upward. You see there's still some big upside potential there. And it's not surprising that it came down quite a bit right here. The valuation just went through the roof on that when everyone just started using it. But now that it's kind of consolidated out of that, it's not like this is going away. It's not like everyone's going to stop using Zoom. And the pandemic is we're still not out of the woods yet on it. So there still could be that potential for a lot of growth on this. So again, you wait for it to go back to that buy signal, give a little bit more confirmation that this thing could be turning the corner. You could even wait for it to break that cycle, the downtrend. You got these lower highs right here, lower lows. Can you break above here to give you a higher high? Show you a little bit more that it's changing, it's starting to trend upward. Yeah, you can do that. You can wait for a little bit more of that confirmation. Although I'd imagine if we got, I'd imagine a move up close to that area would be about where you'd see the buy signal again. But if you want a little bit of extra confirmation on that, you could wait for both. Wait for a buy signal and to go to a higher high and use that as a confirmation there. But I like the pattern that's developing on this one as well. All right, that kind of concludes the market update part. Let's get into talking about shorting stocks. Now, to start off with, you have to learn, you have to understand the difference between buying and shorting and the risks associated with buying versus shorting. It's not accurate to say that shorting is just the opposite of buying a stock. You sell first and then you're going to buy later. There's a lot more complexity to shorting, and there's a lot more risk associated to shorting than buying. For instance, if I buy a stock at $50, and that stock goes down, what's the most I can lose out of that? What's the most I can lose? Well, obviously that stock, if it went to zero, I'm going to lose $50, right? Assuming I have one share of the stock, just to kind of keep the example real simple there. I can't lose any more than $50. Okay. Well, what potential reward do I have? Well, this thing could go, to $500 or something like that, or higher. We've seen some $1,000 stocks. So I have unlimited reward potential. I have limited risk. I can't lose more than $50, but I have unlimited reward. I can make whatever. It's unlimited. I think it could go to $3,000. Okay. Now, what's also an important concept to understand about buying a stock versus shorting a stock is that if the stock goes down, if I buy the stock at $50 and the stock drops to $20, do I have to sell the stock? Do I have to get out of that position? Probably it would be smart as a trader to have stop losses and risk analysis on it and everything, but do I have to? Am I forced to sell that stock? No. I can hold it as long as it's in business. I could go out of business, but that would mean it goes to zero and I'd lose my $50. But I can't lose more than that $50. But it's important to understand I can hold on to this as long as I want. I can wait as long as I want. I can, as long as it's a functioning company, I can hold it for 5, 10, 15 years, waiting for it to go back up in price. And some of you may have stocks that you've owned for 15 years and it still hasn't gone back to the price you bought it. But you have that, you're able to do that. Well, shorting a stock involves, so when we buy a stock, we buy it first. So we buy it at $50 and we sell it later, either at a profit, like $500, or let's say I do finally sell it at $20, I could sell it for a loss. Okay, but you're buying first and then you sell later, either for a profit or a loss or break even or whatever. Now, what if I think the stock that's at $50? Let me erase this here. What if the stock that's at $50 I think is going to go down? All right, now it's really easy to understand how you make money when stocks go up, but let's say I think it's going to go down to $20, and I want to profit from that. I want to make money on that move down, because you hear it all the time. People say you can make money when the market goes up, make money when the market goes down. That's true. Well, what you can do is you can short the stock. It's called shorting the stock, which means that you're selling first. What happens there then is you're borrowing shares from your broker. He's lending you one share of the stock here, and your action is you're gonna take that borrowed one share and you're gonna sell it for $50. So you bring in $50 into your account. Now you can't go out and well, you could go spend it, but you'd be in trouble if you Because you remember, you borrowed that share. You've got to return that share at some point to the broker. It's not your share. You don't own the share. You borrow the shares. What you're hoping for, though, is that you sold the stock at $50. You're hoping that stock goes down in value to $20. And when it does, you're going to go back in, and you're going to buy back that share. So you sold up here. You're going to buy it back down here for $20. Get that share back to the broker. He's got his share back. And you made a $30 profit. Because you sold it at 50, you bought it back at 20, and you get to keep the difference. Okay. Now, it seems real simple and all that, but here's where it gets a little bit more complex. First of all, the shorting stocks are just the opposite as far as risk reward to buying a stock. How far can that stock go down? Well, it can go down to zero, right? So I can't make any more than $50 on shorting a stock. Okay. On the other hand, what if I'm wrong and the stock doesn't go down and that stock goes up to $500? I still have to get that share back to the broker, but now I'd have to buy it back at $500. I sold it for $50. I'm buying it back for $500. I'm going to lose $450. So you have, and how high could it go? It could go to 3,000, right? So I have unlimited risk and limited reward potential. Now, because of that, you don't see a lot of people shorting stocks for long periods of time. Okay. Now, some of the big hedge funds out there will hold them for quite a long time. But usually you're because of that limited reward potential, you're expecting what these guys do, these big institutional traders do, is they'll say, well, this stock is trading at $50, but it's really only worth $20. So I'm betting that this is going to drop down to this $20 range based on whatever your analysis is. It could be based on fundamentals, it could be based on the chart. You think it's going to come down to $20. So you know exactly how far you're trading it to, but again, you're not looking to hold on to this for 20 years or something like that, right? Or not too many people hold stocks for 20 years anyway, but you're not looking long term. You're just trying to capture this downward move whenever it takes place, but you're expecting this just shorter term move. But here's where you have to understand a big difference in shorting stocks is that you can't hold it when it goes against you. You can't hold it forever. I probably can't hold this stock till it goes to $500. Why? Because your broker is not going to let you have that trade get out of control. If you only have enough money, if I only have $60 in my account, he'll let me short the stock at $50 because he knows I've got enough money in that account to cover that if it goes against me. If it goes up to $60, that stock could go up to $60, and I'd still have enough money in my account to buy back that share and get that share back to the broker. But if it goes higher than that, if it goes up to $70, the broker knows I don't have enough money in my account to buy it back. So he's not going to let me get in that big of a hole because he's at risk now, right? He's losing money off of this if he lets this thing get out of control. So what happens if this thing goes up to a certain point where I can't, and it's a little bit more complex than this because they'll let you don't necessarily have to only have the amount in your account to have it go against you. The broker might be willing to lend you some money. The margin is what they call it. So they might let you even let it go a little bit beyond what you have in your account, but you're still going to have to pay that money back. And so it can go a little bit more. In other words, the broker can let it go a little bit beyond what you have in your account to cover that risk. But at the point where he's no longer willing to let it go against you any longer, he's gonna notify you. And nowadays it's an email or a text or something like that. It used to be an actual phone call. The broker would call you. That's why it's called a margin call. And they'll say, hey, by the end of the day, you either need to transfer more money into your account to cover that trade, or I'm closing it out. I'm going to sell it. I'm not going to sell it. I'm going to buy it back, because remember, to get out of that, you got to buy it back. I'm going to buy it back for you so I get my share back. And the broker could actually go in there and close out your trade without your permission to make sure they get their share back, and you'd be wiped out at that point. Okay. So when you short a stock, you have to be tremendously disciplined. And I would strongly urge any one of you that wants to try to short a stock, first of all, start really small. Second of all, don't use any margin shorting a stock. You don't want to get into a big hole to try to dig out of, especially if you don't have experience. And never short a stock until you can prove to yourself that you have discipline to stop out of a trade that goes against you. If you can't, when you buy your stocks, when you're buying your stock at $50, if it drops to $30 or something, and you can't stop out of it, you can't take the loss and get out of it. You just want to wait until it goes back up again. You better not be shorting stocks, because you can't do it. You can't do that same thing when you're shorting. You can't hold it forever and wait for it to go up. And if you try, it's going to wipe you out. You're going to lose everything, because at some point the broker's going to say, you either have to put more money in your account, or I'm going to close out the trade for you. And at that point, you'll be wiped out. So you have to be very disciplined. Now, that's very important to understand that difference between buying and selling, or shorting, buying and shorting, because people that are shorting, if that stock goes up, they have to get out. Now, remember, how do they get out? They sold first, so they've got to buy it back. They've got to buy it back at $60 to close out that short position. So let's talk a little bit about what happened with GameStop yesterday. And so GameStop, let's pull that one up here, GME. GameStop is a stock that was heavily shorted. There was a few big hedge fund people that really felt like GameStop was going to go out of business, go to zero basically. And down here, when it was a $15 stock just a couple weeks ago, they were heavily short. And they were, like I said, they're expecting GameStop to go out of business. Big, huge bets on some of these hedge funds. Well, what happened, if you didn't follow the news, you can probably, it's still on the news and CNBC and stuff like that. You can kind of read up on it, Google it. But there was a group of traders on Reddit. Reddit is that social media app, kind of like Facebook or Instagram, but different, but kind of similar in that people post things and comments and things like that. Kind of like Twitter too, you know. And there's a group on Reddit that just are retail traders. These are average Joes out there. Okay, but they're all in kind of a big group, and what they decided to do is they decided that they wanted to squeeze these big hedge funds on GameStop. Now, there's more to it than just wanting to hurt these hedge funds. They like the fundamentals of it. They like something about the company. I haven't researched that long enough to know exactly what what they're basing their bullishness on the company, what they're basing it on, but they believe strongly that it's going to go up. But what they did is they got together, through social media. They all started buying GameStop. Well, what that caused the stock to do? It caused it to jump. So in one day, the stock went from a $15 stock to a $28, $29 stock, almost a $30 stock. It almost doubled in value in one day. We said, okay, that's great. Why did that stock go up that much in that day? Well, all these people are buying. No, not necessarily. What was going on that day is, yes, there was a whole group that started to buy, but because there are these large groups of hedge funds, or these large hedge funds that were short, they were being forced to get out of those short positions. It was going against them in a big way, and they had to buy back their shares to get out of their short position. So they were having to buy back at $30 what they sold at $15, or even lower, depending on when they got in. So you got all these people buying in, and I have these people buying to get out, and all that buying pressure starts to move the stock up, and it moves up very rapidly because it's a huge amount there's nobody selling at that point, and so the price is going to go up. It's going to go up very quickly. So they squeezed them a little bit right here, and again, they don't have a choice. They could be absolutely right that GameStop is going to go out of business, but when that trade goes against you, you have to get out, and that's where you're really stuck. And what happened was, actually, one of the hedge funds almost went under. They ended up being able to secure a loan from another hedge fund to be able to stay afloat after yesterday's move. And this is what happened with yesterday's move. So you got squeezed right here. It paused for a few days, and the stock went from $40 up to $75 one day. Backed off a little bit at the end of the day, but it made that run. Backed off at 63, and then yesterday it went from opening at actually, it opened up here at about 97, 90, somewhere right there, 97, we'll say. And it ran to 160. And then it came back down, ended up closing at about 75 right here. And then today, they're squeezing them again. See, it went from opening at 87 up to 111. But I mean, look at that move. It was a $15 stock 2 weeks ago. It got as high as $160. Now that's a good example of a short that goes against you. I mean, this is like the worst case scenario that can happen, and that's why it's really freaked out the market, or the market participants, these big hedge funds, is because they're like, man, this can happen to any of our short positions. If this group goes out and starts targeting all these stocks that have high short interest, we're in danger of, because again, they don't have a choice. You have to buy to close those positions. So, but this is also a warning too that you got to be careful of, is when stocks do make these kind of moves up this far, they can come down just as fast. If that buying, remember, at some point, all the shorts are going to be out of the trade. Right? They got squeezed, they got hurt, they bought back those shares, and they're out of this trade no more. They're not in GameStop anymore. And at some point, all these Reddit buyers are going to dry up, and so what happens? You don't have to have short sellers to drive the price of the stock down. There's just be a lack of buying. There's not going to be enough buying pressure to keep it at 100. Well, that's what happened here. There wasn't enough buying pressure to keep it at 160, and so it came down very quick, all the way down to here, very quick, because there was so there's a bunch of short sellers who were out, and there was not enough new buyers coming in to keep it going higher, and it came back down. So but like I said, that's what's going on, and it's not just GameStop. It's happening with a lot of these stocks that are heavily shorted right now. If you remember the old BlackBerry, BB, this has gone through like three different ticker symbols in the last 20 years, but the newest ticker symbol is BB for BlackBerry. Well, similar thing happened with BlackBerry. Let's wait for the chart to pull up here. Let me try that again. It's having trouble loading. Oh, here we go. It was a $5 stock at the beginning of the month and ran up to almost $20. So when these things are done, they're going to come down. And that's why I said don't go run out and start buying all these stocks that are up this high, because they're going to probably come right back down. But again, that's the dynamic of what's going on, and that's the danger of shorting, is that especially on GameStop, they have unlimited risk. If their hedge fund managers are still in this trade, this thing could go to a $200 or something like that. They could get completely wiped out. So we'll see how disciplined they are now. The ironic thing is, the discussion on CNBC yesterday was there's a lot of because there's a lot of professional traders that are on CNBC all day long, right? And a lot of them were bashing against what was going on here. But the hypocritical part of this is that these hedge funds do this to retail traders all the time. And they can do it so easy because of their size, where they just go in and they know they can see a bunch of retail traders are bearish on a stock, think it's going to go down. They're probably short that stock, and they'll go in and buy a bunch and squeeze them really fast. And they do it to retail traders all the time. And that's why I think it's kind of, I'm kind of sitting on the sidelines just kind of enjoying it, because it's kind of poetic justice to see this group of retail traders have banded together. And it's time to make the big hedge fund hurt. And they almost wiped one of them out yesterday with that move. And so, but it also usually what ends up happening, which is it's the unfair part about the market sometimes, is that regulators tend to protect the big traders because they are the big fish that run everything. And wouldn't be surprised if they put out some sort of regulation that prevents this from happening or continuing to happen. But I just find it kind of ironic that all these hedge fund people or professional traders are whining about this over the last couple of days and how unfair it is, and yet it's okay when they do it, but it's not okay when the average Joe trader groups together and does it to them. So. But anyway, that's kind of what was going on there, and why some of these stocks have made these gigantic moves. And a lot of times it's pretty recognizable, because when you ever see a big jump, very short period of time, very quickly, it's usually that dynamic of not only having buyers coming in, but squeezing the short sellers, and they're buying as well to get out, and there's no sellers. It's all buying, and it just shoots straight up. It's nice when you're long on a stock and that happens, especially if you would have gotten into GameStop at $15 2 weeks ago and sold it yesterday at $160. That's a huge once in a lifetime type of trade for you. But that helps explain a little bit about what was going on there, the dynamic of what was going on. But like I said, if you are considering shorting is I love to short stocks. Not in a strong bull market like we're in right now, but when things start going down, and there's that's a way you can make money when markets go down. And because a lot of people don't know how to do it, it sets you apart. Where other investors have to wait for markets to go down, they have to sit on the sidelines and wait until they want to buy back in again. You can be actively making money on that move down, so you can make money when it goes up, make money when it goes down. But I just strongly urge you that you start small, really small at first, just to see how it works, see what it's like to place an order to sell first, and then whether you're buying it back at a loss or buying it back at a profit. But just make sure you start small. Don't use margin. And I don't. At some point, maybe you'll use margin, but at that point, you'll probably know exactly what you're doing, have a lot of experience. Then I don't have a problem with someone using margin if they are disciplined, they know what they're doing. But you definitely don't use margin for anything, buying or shorting, until you know what you're doing, because it could really hurt you bad. And usually people only think about the positive side of borrowing money for shares. How much more money I can make, twice as much money if I borrow another $10,000 from the broker to buy stocks with. They don't think of the downside when it goes against you and you lose twice as much money, and you end up having to owe your broker over a period of time because you've wiped everything out. So be careful. All right, thanks everyone. That's all for today, and we'll see you on Thursday for the stock specific class. Bye now.